items we have here in order to help with your retired clients. Morning, Sonia. How are you?
Good morning. I'm well. How about yourself?
I'm well. All right. Who do we have from Erie? Who's with us today?
I'm in Erie.
Are you in the training room as well?
No, I'm at home.
Okay. I see training rooms on. So is that Fred or is that somebody else?
They just have it on in our office, so anybody who's in the office can hop on.
Awesome. Give me one more minute. We'll jump in here. Probably 15 minutes. We'll roll through this here quickly and then open up for questions you guys have on your end. Seeing if we can help out and maybe get one more deal here by using some of these things or having at least a little bit more education on how to help these clients whenever they are looking to purchase homes or looking to sell homes even. All right, I think we'll go ahead and get started here. Morning, everyone. Rusty with Collab Lending here this morning. Appreciate you guys joining us here. We're going to learn a little bit how to work with clients who are trying to utilize either they're retired, have homes to sell, and or have assets, and they maybe not have traditional income anymore. Maybe they don't have a W-2 income and they're just receiving Social Security, things like that. So our goal is to help them to buy a home, even if they're only receiving minimal income at the time, and how to utilize or leverage their assets or different techniques to do that. So if you have questions, please interrupt along the way. I'm happy to make sure we're on the same page, and we'll go from there. All right, agenda today. We're going to walk through this here. Buying home options without traditional income. Buy before I sell. I'm not listing my home. What's the best use of my retirement funds when purchasing? And I make a lot of money, but I don't show this on my taxes. You run into these self-employed borrowers all the time. So the first one, when you're looking to buy a home and options without traditional income, let's say they're retired at this point now and they don't have that stream of income they were used to. They're just receiving small pensions, X, Y, and Z, things like that, or just Social Security at this point. If that is the case, they can use their retirement assets. So their 401ks, their IRAs, anything like that, they can actually set monthly distributions with them. Meaning, as long as your monthly distribution that you can receive for at least 36 months out of those funds, you can utilize that as monthly income. Now, the caveat here is that what if you don't really need those assets and you don't want to take those monthly distributions after you buy your home? That's 100% up to you whether you continue that income or not. I need to show the income or the distribution to qualify. Quick example. I only make $1,500 a month from Social Security, but that's not enough to buy my dream home that I want to buy. I need closer to $6,000 to show the underwriter that I have more than sufficient funds. That'll cover my monthly payment, and that'll also make sure that it covers any of my other expenses or liabilities I have or bills for that month. Once we utilize that, show that we're taking the monthly distribution prior to whenever the first payment is due. Generally speaking, let's say we close on a house today, your first payment's not going to be due until November. So my first payment's going to come 10/31, 10/30. Great. You're demonstrating that you have the funds that you can withdraw for that period of time and that you have the income now because we've taken a scheduled a distribution for $6,000. If the client chooses to cancel that before their first payment is due because they don't need it, that's entirely up to them. But for qualifying purposes, you've basically made your own income so that you can now buy a home. It's kind of on the backside, without getting into too much detail on it. Every client's a little bit different here, so I'm happy to walk you through if you have a client who has this, and just make sure that the math works. Realistically, it's 36 months they have to have a continuance of. So, if we're looking at $360,000, right, they can take that out whenever they're looking at this for that period. That's their income. Lump sum withdrawals are another one, utilizing some of your retirement for that. Hey, I don't want a mortgage payment. I haven't had a mortgage payment. We're going to talk a little bit more about this, because buying a house cash is great, but what do you do for retirement after that happens, right? Are you be able to pay your bills after that? So we'll talk a little bit more about things like that. The utilization of assets and income is kind of what we looked at. The other piece here, let's say you don't want a withdrawal or anything like that, and you just have a money market that has $1 million in it. That's what your client has. I can divide that by 60 months, and now that becomes what your income is, utilizing some different programs. So taking different averages with different investors or different programs, we can just utilize the straight assets with even out a withdrawal, and that counts as your income again. So there's different programs that allow us to utilize either the assets as a whole or create monthly distributions here in order to help with that. This is the one we run into all the time: buy before I sell. I'm not listing my house until I find a house. We know that inventory has been a problem this year, and it's tough. Asking somebody to list their home before they already have a home under contract, we kind of end up in a catch-22 sometimes. I'm sure you guys have seen this at least once, if not twice or three times in the last couple of years. Utilizing the equity in their home before they sell, most certainly there's always bridge loans. That's one way to do it. The other one might be taking out a home equity line of credit. I have both of those options in order to help. Other times, great, I don't want to sell this. I like the income I can drive from it. I'm going to actually rent it out. If you have a rental agreement on your home, we're allowed to use 75% of that 1-year lease minimum towards what your current mortgage payment is, or offsetting that monthly mortgage payment. So if I have a $2,000 a month lease on my home, I get to count 75% of that, or $1,500, in order to negate that, let's say, $1,300 mortgage payment. Now you have $200 more of income per month, and that frees up in your debt to income ratio to help that buyer and seller, if you will, maybe down the road, in order to qualify. The other thing that I see a lot too, and we have banks that do this for us, is what's called a recast. So I know I'm going to have a really nice payday when I sell my house because I own it free and clear. So I'm going to have $200,000, but I don't have that rate now to buy a home. Great. You could put a minimum of 5% down on a conventional financing loan. Closing costs you have covered. And then after you sell, because I don't want to have to put all my stuff in the moving truck in the parking lot, and then, have with the dog and the kids and everything else, and then have to move in the same day. It's not always fun to buy or to sell in the morning and buy in the afternoon. Logistics, families exist, everything like that. So how can we make this easier for you? Utilizing a recast, which is a re-amortization of your payment. This is a fancy way to say, hey, that $200,000 that you got from the sale of your house that you sold 2 weeks after you bought your new one, we can use 150 of that, and we'll adjust your payment as if you brought the funds to closing originally. Okay. So imagine what your payment, let's say $2,500 prior to the recast with 5% down, but after you put another 100,000 down, now you're at $1,375. It creates a more budget-friendly payment that you're used to, and then you don't have to deal with that $2,500 a month payment that maybe doesn't make your budget comfortable. So there's different ways to do this. We have different banks that we partner with to do that. Normally it's a small cost of like $150 to recast. You can do it multiple times though. So if you want to throw 10 grand at it a month, or 10 grand at it every year, and say, hey, I'm going to recast, you can get that into a budget-friendly payment that would work better for you as a household. That's another thing that we look at. A lot of times I've had people do this, and they take out a $275,000 mortgage, and they take the $200 from the home. Now they have a $75,000 payment versus that $275,000 payment. It's just a nice little tool that we have that we can help with these home buyers who may have that nice paycheck, those proceeds coming, but want to put it towards the next house, but can't necessarily do it right away. They can do it right after closing, and it'll adjust their payment within 60 days. So that's another option here. What's the best use of my retirement funds when purchasing? We are not CPAs. You are not CPAs. Don't try and be financial planners. Send them to their guru. Most certainly, I can tell you that whenever we bring up these topics, my first question is, who's your financial planner? Who are you working with? Because as a whole, if we can get the financial planner on our team, guess what? They're more likely to listen to them who they've trusted with their money the whole way through their life or up to retirement. If we can say, listen, here's the best way to do it. A lot of times, what I can tell you I hear most often is rather than take out these large lump sums and pay cash for the house, we look at it going, let's create a monthly distribution. Let's create monthly income for you in order to help you pay for that monthly payment rather than utilizing all those assets at once. Right now, retirement in the markets, they're not great. We all know that. Everybody's retirement accounts are probably down a little bit from where they were the past couple of years. So the goal here is to let the money do the heavy lifting. That's one of the favorite things I think I've heard from some of my financial advisors I've spoken with here. Don't take out the lump sum to pay cash necessarily if we don't need to. Let the money do the heavy lifting. If you're only taking out $3,000 a month to pay for that mortgage, you're going to have time for the rest of the assets to help recoup through compounding interest in order to let their money do the heavy lifting, let their money do the work here so they can continue to live that lifestyle they're used to, continue to receive that payment, and also pay their mortgage with it. This is my favorite one. I make lots of money. I don't show it. I don't show this on my taxes. So a lot of times, self-employed borrowers, 1099 employees, which is every realtor in here, we kind of look at it and say, hey, we're going to take all the deductions that Uncle Sam will give us. He gets enough of our money, right? That's just part of, I think, how we look at this. So there's different ways to utilize self-employed income or 1099 income with some of our programs. One is bank statements. I see this a lot of times with different companies that are heavy on deposits, trucking companies, things like that. Hey, here's where it is, bank statements. They're going to show that I have lots of assets coming in. And regardless of what I write off, I'm just going to analyze bank statements, whether that is at 3 months, 12 months, or 24 months. I'll take an average of your income based on what you do. I've had consultants do this before. I had a client in Florida that bought earlier this year. She grossed about $250,000 a year. Her taxes says she made 35. Isn't that wonderful, right? We utilized bank statements to generate income for her as a single entity. She was one employee. She was a one-woman show. We had her income at $14,000 a month after we looked at all the deposits. It was wonderful. She was able to buy her retirement dream home in Florida because of that. Asset utilization, we talked about this a little bit earlier. You have those large bank accounts, those business bank accounts, great, let's utilize it. We can go ahead and take an average of your funds that you have in there in order to help purchase and go from there. 1099, this is directly calling out the realtors here in the room. I can use 75% of what's on your 1099 in order to qualify you for an investment property or anything like that you're looking at. Some of the owner-occupied stuff for primary residence is also available on the 1099. They may require a little bit more down. You're not going to get 3% down on these, but we can utilize 75% of that gross that is on that 1099 rather than have to looking at your taxes or anything like that, which normally, hey, we got write-offs, we have marketing, we have everything else that we do. That's the whole purpose of tax laws, that we can write things off. So that's the purpose of it. A P&L statement, looking at a profit and loss. I have one right now. It's a 3-month P&L. Hey, I'm having a really good year. These are my really good months. 3 months of bank statements plus a profit and loss. I'm showing you that I'm making money. There's cash flow here. I have an investor who's utilizing this to buy a couple properties right now. So most certainly there are more than just the traditional Fannie and Freddie that we know, or the bank loans that we're looking at. These are other options to help bring in different buyers. Investors love this stuff. They've been using it for years. So this is maybe a different avenue for you to go after with your clients, or whenever your clients say, I'm self-employed, I don't show enough money, I can't buy something right now, maybe they can. We'll go ahead and look at this with them. Why do I need to know about these options? I can calculate income ahead of time. So my goal here, whenever we look at these, give me your bank statements. I'm going to get it looked at by an underwriter. They're going to give me a calculation and say, here's what you make. Here's what we're qualifying their income at. So before you even write an offer, whenever I'm giving them a pre-approval letter, I've already analyzed bank statements to make sure I know what their income is, what they qualify for, and exactly how the underwriter is going to look at that with that specific lender. I can do it for 3 or 4 different lenders, so we have options. Here you go. Here's our calculation. Make sure it's across the board. One more deal. If you could get one more deal a month by using an investor, by picking up a retired client who thinks that they can't buy because they don't have income right now, and make sure that quick closings on some of these. So a lot of times I have some of different loans that we can utilize that can close as little as 2 weeks on some of these options. Some of them do take a little bit longer. I always say set expectations whenever we're dealing in this realm. Plan for 45 days. If we can close it sooner or need to close it sooner, as long as the client is on board, I'm happy to go ahead and say, hey, yep, as fast as they can get me documents, as fast as we can schedule an appraisal and get it done, that's how quickly we'll close on these. So they are competitive products that can help you win one more deal or get one more sale, or help one more client, one more family buy a home. Questions?
I have a question.
Yes, Sonia, go ahead.
On the bank statement one, what is the credit score for 1099 employees, the one you were talking about? What's the minimum credit score, and do you have to have like reserves or anything?
They do require some reserves on this. Minimum FICO on most of these are around 660 to 680, depending on which investor it is. I'm happy if you want to look at something specific here later on, shoot me a message, and we can look and see exactly where it will qualify, and I'll kind of work up a scenario for you here just on what my lenders have or what they might be able to do for your client.
Okay, and then the one that you said, if a person wants to sell their house, where you said you could have it, like you don't want to sell your house and you have a lease in hand.
Mm-hmm. So utilizing a lease in order to offset the current mortgage payment?
Yeah.
Okay, so utilizing a lease, it's got to be at least a year. Normally you have to have a deposit for whatever the first month security deposit or rent is for whatever you're charging there. So they'll want to see that, hey, here's the first month deposit check for $2,000 that they've already given me, and that year lease signed that says they're going to rent my property for a year. That will help to basically negate your current mortgage payment as long as it is within that 75% of what's written on the lease. So my example was $2,000, 75% of 2,000 is $1,500 a month. If your mortgage payment is $1,500 or less a month, you basically can negate that in your debt to income ratios in order to help you purchase.
Now, would you need anything from that tenant proving that, they really can afford it and all that type of thing? Or that's just like, do you have to get, more involved with that?
I'm going to say less is more here. Do I need to get involved with the tenant? No, I'm going to say that the lease that you're giving me is legitimate, that they can pay for that, and they've already given you the $2,000. As long as we provide that to the underwriter, they'll sign off on it for us.
Okay.
Yeah. We can talk on that scenario if you have something specific here that you're thinking of in order to help there. I'm happy to kind of mastermind with you a little bit and see how you think you can utilize that. I know I've utilized it for clients that are legitimate. I had somebody whose mom was getting divorced. They were going to occupy the son's home and they were going to rent it from them, and he was ready to buy a new home. So it kind of worked out. So different scenarios for different buyers, sellers, things like that. Whenever we look at that, Sonia, happy to kind of look at that in a little more detail if you'd like later on.
Sure. I have another question. So
go for it.
What about if you want to buy an investment property? I know that there's some programs on there that it goes off of the income the property generates.
DSCR. So
Yeah,
debt service coverage ratio.
So what that, I'm sorry. Sorry, I wasn't done with the question.
Go ahead.
So what if the property is vacant? Can you do that same lease thing? Like if you have people say, hey, I'm going to rent it and you got leases and a deposit. I mean, could you do that?
On the DSCR, you don't actually need any leases for it. It actually goes off what the market rent is. So whenever they're doing this, if you notice on all your appraisals, there will be what is called a rent schedule. It's a current market analysis, and I can generate these too. I'm sure you guys can as well with your different CMAs and generate what's the rent and then what's the median rent in the area for someone this square footage, bed, bath, what are we getting? So I can do the same thing on my end to help you out and just make sure, hey, this does make sense. The rental payments will cover the mortgage payment, if you will, based on what the market demands for rent. And a lot of times I see this as investors, it's a huge thing. So it's an easy one. Hey, I don't have to have it even rented. I don't even have to have a lease. As long as the median area rent is sufficient, you're good to go.
So it could be vacant.
Yes.
Oh, and what's your minimum credit score for that?
They do go down to 620, but they're not super fun and rate if you go down there. But I do have, depending on what it is, they can close in LLCs, they can close in personal names with this. So it's kind of like a hybrid commercial product almost, is the way this works. A lot of times investors want to close in their LLCs with the DSCRs. Normally 30% down is what they're looking for. I do have ones that go down to 20%, but of course you're going to see the rate adjust quite a bit.
Great, thank you.
Awesome.
I have a question.
Go for it, Cindy.
Okay, so how does overtime factor into someone's eligibility for a mortgage?
Awesome. So overtime, depending on which program we're looking at, eligibility, normally they want at least 12 months in order to calculate this. So if they're looking at overtime, they want to see 12 months of it, and it has to be either likely to continue or increasing. They don't want to see a decrease of anything, normally more than 10%. So if it is declining, which is like a big no-no whenever you talk about mortgages or income, if it's declining, that's always tough because they're going to say, well, he's not likely to actually receive it whenever they look at that. So whenever we are looking at overtime here, they need to have a history of it. 2 months or 2 years is what they love. 12 months is normally what's required for most programs in order to go ahead and utilize it. But I've even had different ones. Like there was one company, they do like a profit share. So profit share was on the last 3 years and it was increasing. We got to use that just like bonus. Hey, I received 12 grand every year. I got 13 last year. I'm on pace to get another 12 this year. I can average in that extra income or that overtime income kind of the same way. They want to see at least a 12-month history of this. 2 years is what they love, but they can do it with as little as 12 months.
Okay.
Does that help you?
Yeah, it does. All right, and I have one other question.
Mm-hmm.
So I know the market's shifted quite a bit, even in the last month with the rates going up. By the way, what are they right now? 7 1/4?
7 1/4, 7.5, depending on which way the wind blows that week. That's kind of what we're seeing here on conventional.
Okay. So what's happened sometimes is people are getting outbid. So they go in with their offer, they want a mortgage, they're getting outbid. So if the person actually has cash to pay for the whole house, but they don't want to use all the cash, they want to get a mortgage because it just makes financial sense to them, can they go in and offer a cash offer, but then get a mortgage? And I'm not trying to be shady, but I'm just curious how that works.
They most certainly can. I'm going to divert a little bit to Linda here, and I know we've talked about this before, is in the contract, you are allowed to pursue financing, regardless if it's a cash offer or not. And Linda's nodding her head at me. So
Right.
It's written in there that I can show you that I want cash, but then I want to go get a mortgage.
Okay.
And they're allowed to, but it's got to be within that time frame. There is no mortgage contingency. So if you reach that settlement date and your mortgage isn't done and you haven't negotiated to say, hey, here's X, Y, and Z, I need an extension on this to get my mortgage, they can say, well, here's the contract. You said cash.
Right. Okay.
So I think that's the only thing that I would look at on my end. Correct me if I'm wrong here, Linda, but you are most certainly allowed to pursue financing even if you're making a cash offer.
Okay. Thank you.
Yeah, we saw people doing that here a couple of years ago when they were backing up the truck and here's the cash, here it is, but I'm getting a mortgage, and everybody's getting upset. Like, what do you mean you're scheduling an appraisal? Well, knowing your contract, knowing what the law is and how it's written will protect you and help you better serve your clients here. So that would be my biggest thing. Make sure you pour into that a little bit and go from there. That'll help you at the end of the day. especially if you're trying to work in this wonderful market that's super competitive.
Okay, thank you. That's helpful.
Welcome. All right. If anybody has any other questions, please reach out. You can scan the SQR code, grab all my contacts, emails, info. Please let me know if I can help. If you have scenarios, reach out. That's what we're here for, to help with you guys. Thank you very, very much. If you need anything else, let me know. Otherwise, have a wonderful rest of your week.
Thank you
Thanks.
so much.
Thank you very much. Have a great day.
You too. Thanks, Sonia. Thanks,
Bye.
Cindy.
Thank you. Bye-bye.